Hey everybody, Jason Fieber here, founder of Dividend Mantra, founder and publisher of Mr. Free at 33, and of course I write the Undervalued Dividend Growth Stock of the Week articles for Daily Trade Alert. Welcome to another video today. This is a video series we started some months ago, which basically highlight one of the recent Undervalued Dividend Growth Stock of the Week articles. And what we do is we take that article and break it down in a video format, which we hope complements the articles and adds value to the written series, which we're now adding on with the video series here. So, as we talked about in prior videos, of course, we have the Undervalued Dividend Growth Stock of the Week archive, which you can find if you're at dailytradealert.com. You go over to Dividend Growth Investing, you go under that heading, and then you click on the Undervalued Dividend Growth Stock of the Week tab right there, and that'll pull up the whole archive of all the Undervalued Dividend Growth Stock of the Week articles, which is basically just an article. It's my opportunity to present what I believe is a compelling long-term dividend growth investment idea at the time of writing, based on quality of the business, based on a company that I think is not only within my circle of competence, but I think is a company that's fairly easy to understand for the larger investment community, be you a novice investor or a more experienced investor. And then of course, perhaps most importantly, it's a stock that I believe that at the time of writing, again, is undervalued based on a lengthy, robust valuation method, which comprises of not only looking at current metrics against recent historical metrics, looking at where the stock is relative to the broader market, looking at where the stock is relative to its industry, also doing a dividend discount model analysis, and then also looking at professional stock analyses, combining all of that information together into a bottom line and presenting that to the community. So today's video, what we're going to be doing is we're going to be looking at one of the recent Undervalued Dividend Growth Stock of the Week articles, of course, and the one I picked for today's video series is Target Corporation, which probably doesn't really need any introduction. It's a very large retailer with stores across the United States, and I think it's a pretty solid pick for today's video for a number of reasons, which we'll go over as the video progresses. And welcome to today's video. This is the first video I'm shooting actually from Chiang Mai, Thailand, which is a city I've relocated to. It's a city, of course, in Thailand. And I relocated here for a number of reasons, which I've written about on my blog, but I just think it's a fantastic place to pursue early retirement due to the value proposition. Of course, when I look at value, I don't just look at stocks, I don't just look at investments, I look at everything in life. You know, as Warren Buffett said, you know, I like a good deal whether it's on socks or stocks. And so when I'm looking at rent and my food and my utilities and transportation, I want good value. So it's not just in my investments, but also across the spectrum of all of my spending. I seek out value, and I think Chiang Mai offers an incredible value proposition. And in addition to that, there's a community of like-minded people who build online businesses or live off of passive income and come here to pursue their passions without the stress that you find in America regarding covering your bills, paying your bills, the high expenses, and all that stress and everything else. So getting into today's video, I've already pulled up the article. You can obviously, if you're looking at the archive, you click on Target, it'll bring you up to the video, but I've already done that, so I'm going to click off the archive here. And of course, as I've talked about in prior videos, every article, every weekly Undervalued Dividend Growth Stock of the Week article starts out with what I call a big idea, and it's basically a concept. It's me writing about some high-level ideas and interweaving dividend growth investing with life and financial independence and happiness and finding purpose in your life and everything else. Because if we're so busy in our lives working to live instead of living to work and things like that, if we're so busy, I said that backwards. We shouldn't be living to work. We should be just working to live. But if we're so busy kind of with the 9 to 5 till 65 grind, if we're caught up in the rat race, if we're spending most of our waking hours just trying to earn a buck, that leaves very limited resources in our lives to pursue things that make us happy, to pursue our passions and everything else. So today's video, of course, and with Target Corporation's article, what I talked about was kind of there are a number of reasons why I've chosen dividend growth investing as the investment strategy to build my financial independence around. But one of those reasons, which I break down a little bit in the article, is the tangible nature of dividend growth investing. And basically what that is you can look at the tangible nature of dividend growth investing in a lot of ways, but one way is the actual tangible products and or services that these businesses that you're that you're investing in, or certainly that I'm investing in, you might be investing in. There's a tangible nature to that, and Target, of course, is today's subject, today's company that we're going to be going over in the video, and of course that I wrote about in the article. But you can walk into a Target store, you can touch the shelves, you can look at the products, you can see the people shopping in the stores. So that's really tangible. So it's not something that's just some kind of really difficult, hard concept to understand or anything, where you're investing in something and you have no idea what you're investing in. You go into a Target store, it's very easy to understand. Okay, I see what Target is, I see how they make money. It's something that you can actually physically touch. And then probably the more relevant area of the tangibility of dividend growth investing, at least for me, and I think for a lot of people who get into dividend growth investing, is the actual dividend income. Dividend income is very tangible. It's cash flow, real cash money that's funded via the real profit that these businesses are generating. So as Target makes money from selling its products to people all over the country, it generates that profit, and then it funnels a portion of that profit to the shareholders. And as the profit grows, as Target becomes a more valuable company, as it grows its business, as its profit increases, then that flow of cash to its shareholders, which are the collective owners of the company, that flow of cash should also be growing as well. And that's a fundamental belief, a fundamental truth of dividend growth investing. And I talk about in the article how people, when they talk about passive income, they call it a passive income stream. Well, if you buy enough high quality dividend growth stocks, that stream turns into a river. I don't want just a stream of passive income. I want to be deluged with passive income. I want to be drowned by passive income. I want the Mississippi River coming into my brokerage account. I don't want just a little backwoods stream or something like that. So I talk a little bit about that, about how if you really build up a large portfolio of really wonderful businesses that are routinely and regularly growing their profit, and are thus routinely and regularly sending you increasing passive income, then you're gonna build a little bit more than a stream. You're gonna be building enough to claim your financial independence, claim your financial freedom, and live your life on your terms, whatever those terms may be. For each individual person, how they view financial independence is going to look a little different. But the key is that you're customizing a life for you, by you, that your life looks exactly as it should look according to you. I'm currently experiencing Chiang Mai, Thailand. This isn't for everyone. It works for me. It's really great right now. But if your financial independence involves woodworking in the garage, fantastic. But it should be a life that you enjoy. It shouldn't be, well, I'm just going down to the job to make money. So that's a little bit about what we talk about in the article. That I kind of break the ice a little bit. A lot of you readers are longtime readers, and you're familiar with my writing style and what we're getting into, but there's also a lot of new readers that come on board and they're like, what is this guy talking about? What is dividend growth investing? Why should I even be interested? What's the buy-in? And that's a little bit, every article starts out with that a little bit, introduces the strategy, introduces the value proposition of dividend growth investing and everything else. And of course, later on as the article goes, we talk a little bit about it shouldn't just be dividend growth investing. It shouldn't just be, well, I'm just going to go out and buy some dividend growth stock and just go from there. It should be about picking a high quality business that's within your circle of competence, that's also undervalued at the time of purchase. And that's extremely important, because undervaluation confers a number of benefits to the long-term investor, which of course I get into throughout the article here. So those benefits are pretty substantial. They're pretty substantial relative to what you might experience if you were to buy a stock that if it were fairly valued, or undervalued. And I talked a little bit about what those benefits are. There are three major benefits. One is higher yield, one is greater potential long-term total return, and the last one is potentially less risk. And how those benefits break down is, with the higher yield, all else equal, a lower price will result in a higher yield. You know, price and yield are inversely correlated. So if a dividend remains unchanged and a stock drops in price, then its yield will correspondingly rise. That's how that works. So, you know, if a stock is priced at 50, and it's, you know, and you estimate fair value at 50, and then all of a sudden the stock drops to 45, all else equal, that yield's going to rise correspondingly. That's going to result in that higher yield, and that higher yield means not only more income today, but passive income, mind you, but it also will likely mean more aggregate passive income over the life of the investment, because you're already starting with a higher yield, right? But then also each dividend raise that comes thereafter, potentially for maybe decades, is based off of that higher starting yield. So it just compounds out as you go. And of course that positively impacts total return, because income is one of two components of total return. You've got income and you've got capital gain. So you've got the income side right away being potentially boosted, right? And then you've also got the capital gain given a potential boost via the upside that exists between that lower price paid and that higher value and that higher intrinsic value. So if that same stock, again, were estimated to be worth $50 and you get it and you snag it at 45, well, you've got $5 per share worth of potential upside there if the market reprices that stock more appropriately and realizes the fair value, which tends to happen over the long haul. You know, price and value can wildly diverge over the short term, but over the long haul, they tend to converge more reasonably. They tend to reflect one another somewhat accurately over the long haul. You know, value is driven by earnings, and then value tends to reflect price over the long haul. I mean, it doesn't work very well in the short term a lot of times, because, you know, emotions take hold and news articles come out and people are buying and selling, and it's kind of crazy. I mean, just imagine if you were, the stock market is basically like a store. It's a market. And imagine, you know, we're talking about Target today. Well, imagine if you went into Target and every day you went in Target, there were millions of people screaming over prices of all the merchandise. Hey, $10, no, 1001, 1002, no, 909. It's crazy. And then, you know, and then all of a sudden somebody drops a rumor about this $10 piece of merchandise that, you know, or maybe it's a recall. $8, you know, so it's like, it's crazy. That's how the stock market is in real time. But over the long haul, that stuff tends to smooth out a little bit. And of course, if you're getting into undervaluation, it also should limit your risk due to the margin of safety that you build in between that fair value and that price paid, because there's a lot of things that can go wrong with an investment. A business may not perform as expected. A corporation can, you know, there could be malfeasance. They could do things incorrectly, what have you. There's almost an infinite number of things that can go right and go wrong. And of course, you want to protect your downside. You want to limit your chances of downside. And if you can maximize upside, you simultaneously minimize downside. So you always want to have a margin of safety. You always want to go into a stock. If you think it's worth 50, you know, you don't want to pay 50. You certainly don't want to pay more than 50. You want to get it in for as far below 50 as possible, because that creates that gap there that not only affects your yield, your total return, everything else, but it also can positively impact the amount of risk you take on. Not only because you might be risking less overall capital, so that's risky, that's putting less money on the table, but it also, you know, you don't want to be upside down on the investment, and the further below fair value you pay, the less odds there are of that occurring. So getting into Target today, of course, Target's a North American retailer that operates approximately 1,800 stores across the United States. A very large retailer. They've been around for, gosh, over 100 years, I believe. Yeah, more than 100 years. So they've been around for a very long time. And when you think about retail, of course, there's a lot of changing dynamics occurring within the business model. And I take solace, you know, I take a little bit of comfort in investing in retailers that have displayed an ability, a knack to endure and to change as the business model changes. This whole e-commerce thing is not the first time retail has undergone massive dramatic changes since its inception. This might be arguably one of the bigger ones, or you could even maybe say the biggest, but it's certainly not the first. It certainly won't be the last. And I like to invest in companies that have displayed an ability to endure and to roll with the punches and to change and to adapt and things like that. And Target's certainly one of the best ones out there in that regard. And their plan right now, how they're adapting to the changes right now, is they're investing $7 billion over the next 3 years to improve their digital channel, open more than 100 small format stores in priority markets, and reposition more than 600 existing stores. And by reposition, it just means, you know, sprucing them up and you know, redesigning them to reflect a more contemporary consumer. And the huge part of that is obviously improving their digital channel. I mean, Target is not, they're not a slouch in regards to e-commerce, nor are a number of large retailers out there. I mean, Amazon kind of gets the lion's share of the news, but Amazon, if you look at the actual slice of the overall retail market, it's still pretty small. I mean, they are growing quite quickly, and they are, you know, currently the king of e-commerce and everything else. But there's, you know, Target is making great strides in their e-commerce, as we talked a little bit about in the article, and they're investing heavily in that because that is a significant portion of the future of retail. And that said, B&M retail still has value. I mean, Amazon itself recognizes that. They went out and bought Whole Foods because they know that B&M retail, people still want to go to a store. They still want to buy things in person, perhaps especially grocery. And when you talk about e-commerce and when you think about the future of e-commerce being perhaps same-day delivery, well, as many distribution channels as possible is certainly helpful toward that end. And Target already has a built-in distribution model based on their 1,800 stores across the US, as well as their major distribution centers. So they've already got that built in. So they, in some respects, have an advantage, a built-in advantage over Amazon based on that. So if they can configure the business right and get that figured out, then, you know, that's a huge advantage moving forward. And of course, they're going to be improving their existing stores and everything else. Now, that's the plus to that $7 billion investment over the next 3 years. The con to that, the drawback to that, of course, is that may limit some of the dividend growth in the company, because I mean, they're spending $7 billion on growing, you know, on changing the business, on adapting the business, on growing the business, and that limits the amount of cash flow that can come back to shareholders in terms of that dividend growth. Is the dividend going to be cut? No, I very highly doubt that's going to occur. And as we get into a little bit here, the dividend metrics are actually really solid. But going forward, is future dividend growth, at least over the near term, going to look like past dividend growth? Also highly unlikely. So just something to keep in mind there. But they're certainly adapting. They have an amazing track record in terms of endurance, especially, you know, in terms of retail. Retail is certainly not. Retail is like a battlefield with, you know, with corpses or something. You know, a lot of major retailers over the last, gosh, 30, 40 years have just fallen by the wayside. You know, you look at Sears, and you look at a lot of Macy's and JCPenney, you look at all these legacy B&M retailers that haven't really been able to figure out how they adapt their niche toward the new world. And Target is so far, I mean, they're going through a little bit of a rough patch right now, but they're certainly not doing that bad, and they are adapting, and I think they're making some good moves toward the future of retail. So next thing we get into, of course, is dividend metrics, and I talk a little bit about how they have an ability not only to endure in terms of being competitive, and they're keeping their business model alive and increasing their profit and everything else, but also in terms of their dividend. Target has increased their dividend for 50 consecutive years, which is unbelievable. It's amazing. It's not just one of the longest dividend growth track records, period, anywhere in any industry, but certainly one of the longest in retail. I don't know if I can't think off the top of my head if there's any retailer out there with a longer dividend growth track record than Target. I don't know if there is. There might be, but I can't think of one off the top of my head. And if there is, I mean, you're talking very, very few out there who will be able to beat Target. that's, I mean, 50 consecutive years that stretches through multiple wars, multiple economic crises, the Great Recession, 9/11, terrorist attacks, all, you know, you name it. And every single year shareholders could count on a larger dividend than the year prior, which is incredible. So they've grown it for 50 consecutive years, and of course, to pull that up, I think I forgot to pull up David Fish's Dividend Champions, Contenders, and Challengers, so let me get that pulled up, and I'll show you where all the dividend metrics come from. Of course, I pull them up from David Fish's Dividend Champions, Contenders, and Challengers list, the CCC list, which David Fish compiles this information on dividend growth stocks for the community. It's an invaluable resource. Of course, it's got 816 stocks on here, which have all raised dividends each year for at least the last 5 consecutive years. So let me pull this up here and get Target loaded up. I'm sorry, I had all my links pulled up, but for some reason I forgot David Fish's list there. But yeah, 50 consecutive years is just, that's impressive. I mean, you know, if you want to talk about blue chip stocks and companies that, you know, have that kind of track record, that you know, blue blood stock that, you know, everybody wants to invest in, that are generational investments, Target is certainly right up there with any of them that you could possibly think of. Is David Fish's list going to load here? Oh, there it goes. Okay, so we got Target pulled up here, so you can see consecutive years of dividend growth, 50 years, which, again, I don't believe, I can't think of any other retailer that has that kind of track record. Regardless, it's incredibly impressive in its own right. Again, not only for retail, but for any industry in general. And then, of course, the next thing we get into is the 10-year dividend growth rate, which is 18.1%, which you can find right here, which is substantial. If you would have invested in Target 10 years ago, you would have said, well, Target's been increasing their dividend for 40 consecutive years. And if somebody would have said, well, I think over the next decade they're going to grow their dividend at 20% annually, people might say, what? You know, they've been already growing it for 40 years. That's you know, that's crazy. They can't just keep growing at 20% indefinitely and things like that. Well, yeah, they can't grow at 20% indefinitely, but you can certainly grow dividend at a very appealing rate for a very, very long time. And Target shows you that. So they already had 40 years of consecutive dividend growth, and then for the next 10 years pumped out on average an 18% annual dividend increase, which is really strong. That said, though, there is some pretty strong deceleration here occurring, and that's due to that dividend growth really outstripping underlying earnings growth. And you could go back and you could kind of maybe criticize Target a little bit for that 18% dividend growth over the last 10 years. They maybe should have been a little more modest with that, a little more conservative, because the payout ratio has expanded quite a bit over the last 10 years. You can look at that in a couple different ways. You can say, hey, thanks Target for handing me 18% annual raises for doing nothing. Really appreciate it. That's more money in my pocket. But you could also say, you know, maybe we should have been a little more conservative with that. That might have been a little too strong. But you see some deceleration here. 5-year dividend growth rate 16, which is still strong, but then it drops off quite a bit. 3-year dividend growth rate 13, 1 year 7. The most recent dividend increase was only a little over 3%, which is obviously a steep drop off from where it was over the last 10 years. And this is really more reflective of what I think the near term, at least over the next few years, while they pump in $7 billion back into the business, that's a little more reflective of what you might be expecting over the near term. You know, mid-single digit dividend growth, I think is a pretty reasonable expectation. And talking about the payout ratio, talking about the expansion of the payout ratio, let me pull up the key ratios for Target over the last 10 years. We'll actually see that payout ratio grow a little bit. And let me pull up the current payout ratio. So you see their current dividend. Let me just make sure that's a whole number here, which I believe it is. Yeah. So we've got an annual dividend at $2.48. We've got TTM EPS at $4.95. So I guess it's a payout ratio of 50.1%. which I didn't round or anything. I just put it at 50%. That's pretty much where it's at. And then when you pull up Morningstar's, when you pull up that key ratios tab under Morningstar, it'll give you 10 years of financial data. And as I've talked about in prior videos, Morningstar's pretty accurate. I would say they're if I had to put a number on it, I think I've said this before, but if I had to put a number on Morningstar's accuracy, I'd put it at probably somewhere between 90 and 95%. Sometimes you'll see some of these numbers off a little bit, but if you had to just rely on Morningstar for all your analysis, it's not something I would recommend. But I would say 90 to 95% of the time you're going to get the correct number. But getting back to that payout ratio, 10 years ago, the payout ratio was 15.6%, which is extremely low. And obviously Target had plenty of room to grow that payout ratio. Should they have grown the dividend at 18% annually over the last 10 years? As we'll see with the underlying earnings growth over the same period, maybe not, because even before the business started to slow down more recently, you see the payout ratio just growing 15, 17, 22, 25, 28, 40. This was kind of an off year due to they had some adjustments with Canada and everything, but you see the payout ratio just every single year creeping up a little bit, and some years maybe quite a bit, and they should have been a little bit more modest with that. But still, the payout ratio is 50% right now, and as I've talked about before, I consider 50% a perfect payout ratio, if you will. I don't know if there's any such thing as any perfect financial metric, but I consider it a very nice balance, a harmonious balance between retaining profit for the business to continue growing it, and then paying shareholders their fair share of the profit of the company, because shareholders are the collective owners of any publicly traded company. So if I own, if I had a pizza shop, Papa Jason's Pizza Shop, and I owned this business outright, and I had people running it for me, and I were just sitting, and I were just sitting at home and just collecting my money from Papa Jason's Pizza Shop, I would expect a paycheck. I would expect money to come in. I wouldn't just sit there and wait for years on end for the business just to become more valuable and then one day start selling off a stake in my business. I want to keep my stake in my business. First off, I want to keep Papa Jason's Pizza Shop, but I want my paycheck. I want my share of the profit. So from every pizza that this pizza shop is selling, I want a chunk of that money, and that's kind of what you're getting when you're getting a dividend. And as that business grows in profit, as the profit increases, then so should that little paycheck. And when you're looking at 50%, what that's saying basically is that Target is retaining 50% of its earnings, so it's keeping 50% of its earnings to reinvest back in the business, and then it's sending the other half. So for every $1 of profit, 50 cents is going to shareholders, 50 cents is staying with Target. And I consider that a pretty nice balance. It's a nice compromise. It's saying, okay, shareholders, we understand you want your fair share. Here it is, but we need to also continue growing the business, because if we send you all the profit, then eventually there's going to be nothing left, and then we're not going to be able to stay competitive. We're not going to be able to, as we see here, they have to invest back in the business. We need to endure. We need to adapt. So they need that flexibility, obviously. And I talked about the payout ratio tripling over the last decade, which is again, they should have been a little bit more modest maybe with the dividend growth. Hey, kudos to them for taking shareholders seriously and saying, hey, we want to hand you out nice dividend increases. You guys are the owners. We value your relationship, and kudos to them for that. But with more than tripling the payout ratio from 15 to 50, that not only limits the dividend growth moving forward, because they can't continue to just expand that payout ratio indefinitely, but it also limits a little bit of the flexibility moving forward in terms of reinvesting back in the business, because they're sending out a much larger chunk of the profit. So again, maybe hindsight's 20/20 a little bit, but again, I think investors need to reset their expectations for dividend growth due to a combination of that payout ratio growing quite a bit and being a balance, a harmonious balance, and certainly a modest payout ratio in absolute terms and in relative terms. But again, with the changes, with the $7 billion in investment, we need to reset our expectations a little bit. The nice thing about Target, though, is that due to the valuation maybe being reset, the stock's come down in valuation compared to its recent historical average, and due to those massive dividend increases being pumped out, kind of the valuation dropping and then the dividend growing, the yield is now quite high for the stock. It's sitting at 4.25%. When I wrote the article, it's 4.24, so it's basically unchanged. And if we want to compare that to where Target has been in its recent historical average over the last 5 years, the yield, so this is Target's 5-year average yield, which that's 2.7%. You're now looking at over 4.2%, getting close to 4.3%. So that's a major spread. As I noted in the article, it's more than 150 basis points higher. Its current yield is more than 150 basis points higher than the stock's 5-year average yield, which you can see here at 2.7%. So a yield of 4.2 would put you at 150, and it's a little over that right now, right? So it's getting close actually to 160 basis points. That's huge. That's massive. But again, I think what's happened with Target is basically it's become a little bit less of a growth play, both dividend growth and underlying profit growth, and a little bit more of an income play. So investors buying Target stock today are buying into a different stock and a different business than they were buying into 10 years ago. The payout ratio is higher, the yield is higher, the growth potential is maybe a little bit lower, the expectations are different, and I don't necessarily think that's all that terrible. You're getting a much higher yield than you were getting a little while ago. So you're getting kind of that higher starting yield in exchange for maybe less dividend growth moving forward. So it's kind of, you know, bird in the hand, two in the bush. You've got a little bit more bird in the hand than in the bush. And for some investors, that's very okay. I certainly appreciate yield. I appreciate yield as much as the next investor. Maybe they should have been a little bit more balanced with everything now that we can see where they're at 10 years down the road. Again, hindsight's 2020. But you know, it's a very nice yield right now, 4.25%. You're talking about utility yield. You're getting into telecom yield at this point. So with still what's been a very solid long-term business with numerous competitive advantages, especially in terms of adapting itself toward more e-commerce sales. They have that network already built in terms of the physical distribution network. So, you know, is Target going to be able to grow faster than a local utility that's very geographically landlocked and has maybe a limited growth potential in terms of growing customers and growing its rate base and everything else? I don't know. I mean, and certainly the valuation, you know, as we get into it in the article, it's a much lower. So you're getting a utility-like yield on a much lower valuation with potentially greater growth potential. So there's some things to like here. Target has some things to not like. You know, the retail industry in general, the retail business is pretty tough. It's always been tough. It's always been very competitive, and that's only getting worse lately. But when you get into a utility-like yield on a valuation that's maybe half of what a utility might be with potentially greater growth potential, there's some things to like there. So, and I note here too, with that starting yield, you don't need 18% dividend growth when you have a stock yielding over 4% to get you where you need to be. When you're getting yield over 4%, if you're aiming for 10% total returns, assuming a static valuation, dividend growth of 5.5–6% or so, that gets you there. So we although we need to reset our expectations regarding Target and dividend growth and underlying growth and everything else in terms of where Target's maybe going to be going forward after it starts to reposition itself, those expectations we're resetting expectations, but we're also getting much more income today. So there's some compromise being made there, and again, I don't think that's necessarily all that bad. But as I note here, it shouldn't be all income and no growth. I mean, Target is paying out a much higher dividend than it was in terms of its yield and in terms of actually its actual dividend. Much higher than it was 10 years ago. But that isn't to say you want no growth. You still want to see Target continue to grow its business. You still want to see dividend raises. You still want to see those increases. You still want to see profit increasing. You still want to see Target growing as a business. So it shouldn't be all income, no growth. You want that growth. And when we get into the valuation here, in order to start to build a base case expectation for forward growth, you need to kind of look at where a business has been over the last 10 years. So in order to build in an expectations for dividend growth, you need to build in an expectation for profit growth. Profit growth fuels dividend growth. And in order to get to profit growth, you need to see where business has been going, where it's been over the last 10 years, using the last 10 years as a proxy for the long term, and then also look at maybe a near-term expectation, combining those two, kind of saying, okay, well, this is where it's been over the last 10 years, this is where we think it might go moving forward, at least over the near term. So this kind of looks like where Target is maybe going moving forward. And once you kind of build in that base case expectation for profit growth, you can then move into a base case expectation for dividend growth, right? You see how those two kind of follow each other. So looking at the last 10 years for Target, of course, I pulled up the investor relations site for Target under company. I'm sorry, where was I here? Yeah, so under company, you got the investors, investor relations, and you got all the individual tabs right here. I pulled up annual reports, which is where I'm at, and then I pulled up I pulled up 10 years worth of annual reports, which I pulled up the most recent, which is 2016's annual report, and then I've got 2007. So looking at these two annual reports, and what's nice about Target is that you don't even actually need to scroll down to all the individual financial statements. Target does this really cool thing where they give you a financial summary very early on in the annual report. You can see in 2016 it's on page 4, with 2007 it's on page 18, if you want to follow along here. So it breaks everything down pretty nicely. You've got basically the entire income statement there. You've got quite a bit of balance sheet information, and you got a lot of stuff. You've got the square footage growth, total number of stores, distribution centers. Gives you a really nice snapshot of what Target did over that fiscal year and where it's positioned for the next fiscal year. Getting into that, of course, the first thing we look at when I look at the last 10 years of growth, I look at revenue growth. Revenue growth is not nearly as important as earnings per share growth. However, you need to grow sales at some point. I mean, very low sales growth can still make for pretty solid underlying earnings per share growth based on improving margins or share buybacks. There's a lot of ways you can kind of you can kind of squeeze a little more juice out of a lemon, if you will, with revenue growth. But you still want to see some solid revenue growth. And as I've talked about before, I usually look for, when I'm looking at mature companies, I like to see mid-single digit, between 4 and 6% revenue growth from a fairly mature company. And obviously Target is a mature company, been around for over 100 years. They're doing over $60 billion in sales. That's a mature company. As we'll see here in a moment, revenue growth has been a little disappointing over the last 10 years, which is why I think, again, they should have been a little bit more modest with that dividend growth. But we're going to get into the last 10 years. So 2007, we see total revenue $63.367 billion, which I reflect right here, and the most recent fiscal year $69.495. You see right here, total sales $69.495. So in order to get the compound annual growth rate, we need to punch in those two numbers into a compound annual growth rate calculator. I use Investopedia's compound annual growth rate calculator. You're free to use whichever one you like, but I like this one personally. So we use the first number, 63,367, and then we use the ending number, which is 69,495. And we're using 9 periods because the first year, that 63,367, is a starting point. It's not a growth period. It's where you're starting from. So it's actually 9 growth periods every year after that. So we've got a compound annual growth rate of 1.03%, which I reflect in the article right here. And that's disappointing. I would have preferred to see even something closer to maybe 3% would have been a little better. But 1% is not great, and I think that's why the expectations need to be reset. That's why I think the yield is higher. That's why the valuations come down, and that's why it's become more of an income play, a value income play, than a growth low yielding stock or relatively lower yielding stock. The next thing we get into is earnings per share growth, and we see we want to look for diluted earnings per share, of course. So we see right here for that fiscal year 2007, we see 333. And then the most recent fiscal year, We see net earnings, diluted earnings per share, net 470, which I should have reflected in the article, 333, 470. So again, punch it in, 9 compounding periods. We've got a compound annual growth rate over the last 10 years for bottom line growth, earnings per share growth, 3.9%, which I reflect in the article here. And again, not great, almost 4%, but you see over the last 10 years, the dividend growth was 18%, far in excess of what the bottom line has grown at, which is why you see that payout ratio more than tripling, guys, right? I mean, that's it's just basic math here. That's why I like stock analysis. That's why I like investing. That's why I like reading this stuff. That's why I like doing these videos. It's math. You know, you can't really argue with numbers. You see what happened here with Target. Target maybe put the cart before the horse a little bit. They were growing their dividend at a very, very aggressive rate, and the business just didn't support it. And they need to slow that down now. They need to make up for past mistakes. They need to now invest in the business, and they're playing catch up a little bit. They should have done some of these things. They should have slowed the dividend growth down 5 years ago, 5-6 years ago, and this $7 billion investment should have started happening also 5 years ago. So this all should have already been in play. They're a little late, but better late than never. And as a result of that, as a consequence, again, Target has that lower valuation, that higher yield. So investors buying in today are potentially saying, hey, you know what? I'm collecting a much higher yield today, waiting for Target now to kind of catch up and to put the money in the business and to do the things they need to do. And I'm collecting a little bit more income today for my troubles. And again, that's not that bad of a thing. But what happened here, the excess bottom line growth relative to the top line, you can see what happened here is, if we go back to the key ratios, basically what it was Target was buying back quite a bit of stock, as we'll see here. I don't think there was much change with the margins, and I usually look at net margin because that's net, that's bottom line margin. Yeah, margins didn't really change that much, pretty much static, which is actually a good thing. I mean, the last thing you want to see with the retailer, because retailers are already dealing with very razor thin margins anyway. The last thing you want to do is see margin compression with a retailer. You don't want to see that thing compress. You want to at least see it holding steady, if not increasing, but you definitely don't want to see that thing dropping. And we really didn't see that here with Target. I mean, you can see gross margin maybe a little bit of deterioration. I mean, it's pretty much static. But what really happened, again, as I was talking about just a couple moments ago, was the buybacks. You can see that here. So you see shares, 850 million shares, and most recent fiscal year, 583 million. So they reduced their outstanding share count by over 30% over the last decade, which I reflected right here. So reduced its outstanding share count by over 30% over the last 10 years, and that's what has affected that bottom line growth. That's what has accounted for that. That's how you can account for that excess bottom line growth relative to the top line, relative to revenue growth. And you know, maybe you could have, again, hindsight's 20/20. Maybe you could have said, you know, should they have bought back all that stock? Should they have grown the dividend as aggressively as they have? You know, should this money that they spent on buybacks have been pumped into the business? Could they have done this $7 billion investment in prior years? There's some mistakes they made, some things you can say, and that's with any business, really. Even the best businesses in the world make mistakes, and you can always say, well, you know, you should have done this and you should have done that. And of course, we can Monday morning armchair quarterback the thing, but you know, they are adapting now. They are getting to the issues. They are reinvesting back in the business. They are taking these things seriously. The dividend growth has slowed way down. The payout ratio is still moderate. The dividend is still very secure. So there's, again, some things to like, and you are getting that higher yield now when you buy into it today. But so we see where they've been at over the last 10 years. And again, as I noted earlier, you want to look at a near-term forecast for profit growth, which, as I've talked about before, I use CFRA, which is formerly S&P Capital IQ, their reports, and they have a 3-year projected earnings per share compound annual growth rate right here on the top right, and they have it at 10% for Target. And I note that, where do I have that? Yeah, right here. CFRA believes that Target will be able to compound its earnings per share at an annual rate of 10% over the next 3 years, which would obviously be much better, at a much greater rate of growth than what Target's delivered over the last decade. And I know that that'd be a tough mark to hit. you know, would I anticipate that Target's going to grow its earnings per share at 10% over the next 3 years while they simultaneously invest $7 billion back into the business? You know, I don't know. I will say, as I note here, the big story in retail is obviously the shift toward e-commerce, but Target isn't exactly dead in the water here. The most recent quarter 2 fiscal year 2017, saw 32% growth in comparable digital channel sales, which was an acceleration year over year. That's pretty solid e-commerce growth. As I noted earlier on in the video and in the article, it's not like Target is just sitting around twiddling its thumbs while Amazon sells everything online. Target is also selling quite a bit of product online, and their digital channel sales, which is e-commerce effectively, is seeing an acceleration in growth. And as they invest back in the business, you would only expect that acceleration to further accelerate, which is good news. You know, there's certainly nothing to dislike about that number, 32% growth. I mean, it is coming off of a small base, you know, so you can argue that. But it's not like Target's just sitting around and not selling anything online and not taking advantage of the growth in e-commerce. They are. But will that translate into 10% compound annual growth in the company's earnings per share over the next 3 years? Again, while they simultaneously invest heavily back in the business. I would reset my expectations for Target, and the next 3 years are investment years. That's what's happening here with Target. These are not growth years. These are not, okay, we're getting into the bottom of the basement into a Silicon Valley startup or something. That's not where we're at with Target. Target is reinvesting back in the business for the next, you know, number of decades. That's what they're doing. They're playing the long game. So if you're getting into Target because you think that Target's going to grow at 10% over the next 3 years, you're getting in the wrong stock for the wrong reasons. You should be getting into Target because they're taking the changes seriously. They're playing the long game, and you think that over the next 20 to 30 to 40 years, Target's going to deliver very solid dividend growth year after year after year. Your aggregate income is going to be substantial. It's going to allow your passive income stream to turn into a river, and it's going to deliver strong total return, right? That's why you get into Target. That's why you're in it. And as I note here, Target doesn't really need to hit this 10% compound annual growth rate to be a compelling investment right now. You know, even a modest improvement over the last decade would be more than enough. If they deliver 6% earnings per share growth, that's very much a lot to like with that 4% plus starting yield. And that would support like dividend growth with that payout ratio being at 50%. I wouldn't like to see a payout ratio expanded any more than it already has. I mean, it's more than tripled over the last 10 years. So if that payout ratio stays at 50%, you know, just kind of modulates around that number over the next 5 to 10 years, I'd be very happy with that. And so 6% earnings per share growth would support like dividend growth without a bump up in that payout ratio. So again, do they need to hit 10%? No, but if they come anywhere near that, and if they can just accelerate off of this 4% mark over the last 10 years, then that would be very much that'd be something that I think investors would applaud, and I think you should be very happy with something like that. So getting the rest of the fundamentals, of course, we get in the balance sheet next, long-term debt to equity ratio and interest coverage ratio. And again, as I've talked about prior, I view the interest coverage ratio here as a much more valuable metric, a much more relevant number, because the long-term debt to equity ratio, it's just saying how much debt a company has relative to its shareholder equity, with shareholder equity being impacted by all kinds of things. It's a bellwether metric. Usually with a lot of companies, and Target would qualify, anything below 1 is good, anything above 1 is not that great. And that's where Target's at. They're a little over 1 here, and I'll show you where that number comes from. So, and again, Target's really kind of cool with the way they highlight everything right up front on the annual report. That's really nice. They don't just bury it in page 62 or something like that. It's just they put it right there, like, hey guys, for better or for worse, this is where we're at. And I like that. They hit you right away with it. So we got debt, net debt, a little over 11 billion, right? You see right here, net debt 11,639, and then you got shareholder equity, shareholders investment. That's what they call it, 10,953. So you got a long-term debt to equity ratio 1.06. Not great, not terrible. It's just okay. Again, I don't place a lot of importance on it anyway. The number I really look at is the interest coverage ratio. And actually in this case, the two kind of reflect each other. This interest coverage ratio 5 and this long-term debt to equity ratio 1.06 they have a pretty reasonable relation to one another and pretty accurate. You would expect an interest coverage ratio of about 5 to kind of match up with a long-term debt to equity ratio of above 1. You know, I would kind of expect that. And where we get that interest coverage ratio, of course, we're looking at EBIT and interest expenses. So we've got, let me kind of find it here. Yes, you've got earnings before income tax, $39.65. Add back in your interest expense, which is right here. So you got $4,969. Actually, they list it right here. They list EBIT right here. And that's all EBIT is. EBIT is earnings before income, taxes, and interest expenses. So you've got just under $5 billion, and you've got your interest expense of a little over $1 billion. So you've got an interest coverage ratio of right about 5 if you want to round it up. And again, that's on the bubble for me. Both numbers are kind of on the bubble. The balance sheet could be improved a little bit, and again, that relates back to what I've been talking about all along with this video, with that overly aggressive dividend growth and the limitations for the business moving forward. So you know, they don't need to grow the business at 10% to get to where they need to be and to where I think they should be and to where I think a lot of investors and shareholders would like them to be. But they need to do a lot of things simultaneously. That the balance sheet could be improved a little bit. They need to make good on their $7 billion investment over the next few years, and they need to continue growing the business and pumping out dividend increases for shareholders. So they're juggling a lot right now, and I think that that overly aggressive dividend growth just added another ball in the air for them to juggle. It's just a little bit more stress. It's like, we got to keep everything moving, and okay, we got to hand out those dividend increases. Okay, we're growing the business, we're investing, and the balance sheet, you know. Is the balance sheet a priority? No, it's not a priority, but an interest coverage ratio of 5 is not excellent. That's kind of on the bubble. I like to see anything above 5 is really good for me. Is 5 troublesome? Not particularly. They can cover their interest expense via EBIT 5 times over. They're not under any kind of financial duress or anything, but it's just kind of one area of target where it's like, you know, I'd like to see an improvement there. The dividend growth, you know, they maybe were overly aggressive there, and you know, the overall growth is, you know, just some things where it's kind of, you know, you'd like to see some improvement. And again, that's why the valuation is where it's at. That's why the yield is where it's at. So you're buying into the stock now after mistakes have been made. But if those mistakes can be corrected, you're getting in now, and it acts like kind of like a spring where it's like, okay, expectations are low. Okay, we're bottoming out. We're getting that high yield. Oh, the business is improving, and you ride that thing up, right? The next thing we get into, of course, is profitability. And for some reason, CFRA, I usually use their 5-year average on this, which they list right here. And for some reason, they had net margin at you know, NM. I don't know why they did that. You know, I assume that means not measurable or not applicable or whatever. I have no idea why they did that. What I did was I just simply took Morningstar's numbers here, the 5 years in net margin here, and averaged them out. Same with return on equity right here. Of course, keeping in mind that 2015, as I spoke about earlier, was an off year. All the numbers for excuse me, for 2015 were just kind of off because the company had to take a massive charge to get out of Canada. They expanded into Canada. It didn't really work. They had to get out of Canada, and it cost the company some money. Again, that was another mistake they made over the last 10 years. So you're buying in after these mistakes have been made, after hopefully they correct it moving forward, and as you ride those corrections in the business to greater profit and greater dividend growth and more improvements, and you know, away you go. So that's what I did there. You've got total net margin over the last, actually for, I think what I used for this, I thought I averaged it out in the article, but did I just use it for the last fiscal year? Yeah, I did. 3.93%. So let's see. I'll show you where we get net margin from. You're basically just taking net income and taking that against revenue. So yeah, net income here, 2737. net earnings. Let's see if Morningstar reflects that too. Yeah, they've got it right here. So like I said, they're usually pretty accurate. So you got net income right there. You're taking that against revenue, 69,495. You've got net margin at 3.93%. And that's where I did that. So I thought, I'm sorry guys, I thought I averaged out over the last 5 years, but since CFRA just decided, I have no idea why they decided to just kind of get rid of it or whatever. I'm guessing maybe because the negative number skewed the 5-year average is my guess. That's probably maybe why they did that, but the last fiscal year came in 3.93%. So instead of using a 5-year average like I usually do in the articles, with this one I guess I just said, well, let's not do the 5-year average because of that one fiscal year kind of throwing everything off. And then return on equity came in at 24.99%, which again, you know, you're just taking net income against equity. As I talked about again in prior videos, net margin is the number for me for profitability. Return on equity it's just, you know, your net income against equity. I don't know why investors place any real importance on that. It doesn't. It's kind of like, I guess, return on net worth of a business, if you want to look at it that way too. It just, what you really want to know is net margin. You want to know if you're selling $1 worth of goods, how much are you making off that dollar? You want to get as many pennies off of $1 as possible. If you can make 20 cents off of $1, then that's a hell of a lot better than a nickel off of $1, and that's where you want to be. With retail, it's tough. And with retail, you're usually looking at low margins because of the nature of retail, and 4% is not that bad. I'm not disappointed at all with that kind of number, especially with some of the concerns they've had. That's a pretty solid number overall, in my opinion. And that's what we get into here near the end of the article. I just note that it's a great business. It's not a terrible business. They've made some mistakes, but they do cater to high-end clientele. You know, these the typical shopper at Target is not like a typical shopper at, say, Walmart. They're a higher-end clientele. They're going in for higher-end merchandise. Target does a lot of co-branding. For instance, they just recently announced that they're doing some branding with Magnolia, which of course is that brand behind the HGTV show. What is it, Fixer Upper, I believe it's called. You have Chip and Joanna Gaines out of, where are they, Waco, Texas, and they go through and totally revamp these houses. And I guess they're not going to do the show anymore, but they are working on their brand, and they're working with Target. I think they signed a 5-year deal with them, and that's what Target does. They go after some really popular people, really popular brands. They co-brand with the store, and they bring in exclusive products, and that tries to draw the foot traffic while simultaneously repositioning the stores, reinvesting back in the business, growing the digital channel, and of course the small format stores that's important too in key markets. You know what Target's been trying to do is they've been trying to grow these smaller, more convenient stores that are very much the opposite of these large warehouse type stores that they have in a lot of cities. They're just these really small stores that sell a lot of, you know, really necessary products in urban markets, like a Chicago. You have these smaller Target stores that are in highly walkable, highly desirable areas where they get a lot of foot traffic. People are coming in and just all day long just picking up little things here and there, and that's maybe where the future of retail might be as the country and as the world grows to be more urban and more city dominated, and as more people live in cities and things like that. I certainly know that living in Chiang Mai, people are walking everywhere. They're stopping in all day long in these 7-Elevens and these little stores, picking up this, picking up that, grabbing some water, grabbing this, grabbing that. And that's maybe where the future retail is, along with that e-commerce as well. And that's where Target's focusing. And of course, they're repositioning those bigger, older stores as well to remain competitive and to endure, but they're also taking the future of the business very seriously as well. So getting into the valuation here, Target's valuation, we've got a PE ratio of 11.8 here, which is, again, in relative and absolute terms, very low. You're not going to find many retailers with that kind of low PE ratio, and you're not going to find many businesses maybe with that low PE ratio, and it certainly compares very well to the broader market, to Target's 5-year average, to the industry average, as we see here. So check this out. So price earnings ratio, they have it 11.9. The industry average, almost 20. The broader market, well over 20. The 5-year average for Target's over 17. So again, you see that disparate disconnect between where Target is right now in terms of expectations, in terms of its valuation relative to where it's been over the last 5 years. So Target investors or shareholders that bought into Target, say 3-4 years ago or whatever, on average over the last 5 years, were buying into much higher expectations and a lower yield and what they thought was going to be higher growth and everything else, and that didn't pan out so well. But buying in today, you know, how much can Target disappoint you? They're investing $7 billion in the business. The e-commerce growth is accelerating. They're growing out their small format stores. I mean, they're making a lot of moves that, I mean, if I were brought into the business, I would say, yeah, okay, I think that makes sense. I mean, I don't know where you can say, well, that doesn't make sense or this isn't a good idea. I mean, certainly over the last 10 years, you could have said, okay, the dividend growth, you know, that I think we need to slow that down, and I think we need to really take some of these investments seriously. Well, they're doing all that now. The dividend growth has slowed dramatically. The investments are there, and the expectations are low. So precisely when the expectations maybe should be higher, they're lower. And that's where we see the disconnect, and that's where we see the undervaluation. And you see all the metrics here, right here, lining up against their 5-year average, lining up against the industry averages and everything. And you just see much lower numbers here for Target across the board, especially with that yield, as I noted before. You've got the 5-year average at 2.7. The current yield is over 4.2%. You know, 150 basis point spread. You're certainly getting something much better than retail in general and the broader market. You see all the numbers here. So you're getting it's an income value play, which with very low expectations, and Target wouldn't be hard pressed to beat those expectations. Is kind of what basically what I'm saying. So next we get into the dividend discount model analysis. I used a 9% discount rate on Target stock due to that higher yield. And let's see, we got to get back to the dividends. We got 62 cents. So we got an annual dividend of 248. And I've got the growth at, let's see, I put the growth at 5%, which kind of, I don't know if I want to say splits the difference, but what we've got is we've got a very high long-term dividend growth rate, over 18%. That's not reasonable for today. That's not at all relevant to where Target is at right now in late 2017, in October of 2017. The most recent dividend increase was almost, what, 3.5%. I'm certainly not splitting the difference. I am very much on the conservative side for expectations for dividend growth moving forward. CFRA has their 3-year earnings per share growth rate at 10%. Target has delivered 4. I'm at 5. So, you know, if you say, okay, we think they're going to grow at 10, they grew at 4, you know, we're going to split the difference and be somewhere at 7. I'm not at 7 here, guys. I'm taking a very conservative stance on Target's long-term dividend growth rate. The expectations here, again, with a lot of room for upside on this. I'm being very conservative with this. I'm not saying, boy, if they do this right and do that right and everything works out, then they could maybe deliver this. I'm not saying that. I'm saying that if they do even just a little bit right, if just a few things go right for Target, then 5% should be very easy to hit. But there's, you know, if this is terrible, then this is 5%. But there's still a lot of room way over here for them to kind of grow off of that. So that's where I'm at with that 5% long-term dividend growth rate. This isn't a 2-stage, so that's irrelevant. And then I use a 9% discount rate due to the higher yield. And we get a fair value of 65.10, which I reflected right here. And then the next 4 paragraphs get into why I use a dividend discount model analysis, which you can read there. And of course, I compare my analysis to Morningstar, to what Morningstar and CFRA come up with. They're professional stock analysis firms, so they employ professional analysts to go through and follow these businesses very closely and then come up with what they believe is a fair value for the business and its stock. And I compare my analysis to theirs. I don't necessarily compare theirs to mine when I'm privately buying stock or when I'm analyzing a stock for my own portfolio. I place more importance on my own viewpoint, but for the purpose of these articles, I think that comparing these numbers adds depth and adds value for your readers. And instead of just relying on what I'm saying, you know, you're looking at dividend discount model analysis, you're looking at the valuation compared to the industry, the broader market, its recent historical average, you're looking at professional stock analysts. So I'm using all these things and combining them all together for you. So my opinion is just one of it's almost in the peripheral. It's just one kind of piece of the pie, one piece of the puzzle. So comparing my analysis to what Morningstar and CFRA come up with, Morningstar has Target as a 3-star stock. That's 3 out of 5. So basically they're saying it's fairly valued, or pretty close to that. They've got the fair value estimate at 58, which you see right here. And then CFRA, they also rate stocks on a 5-star scale. They have it at a 3-star, again, kind of as a hold, fair value, whatever you want to call it there. And then they have the fair value at 66.64, which is pretty close to what I came up with, right? So you've got 66.64 right here. I came up with 65.10, so I'm kind of in the neighborhood there with CFRA. And then if we just average these three out, which is where I get the bottom line from, you got 66.64. Whoop. And then you got 65.10. Divide them out. 63.25 right here. And I've got the stock at the time of writing about 8% undervalued. Let's see where it's at right now. It's the same. So that hasn't really changed, right? So we've got the stock at 8% undervalued right now at the time of writing, and at the time of the video, 58.87. Yeah, it's right in that range. So this is the bottom line here, guys. Target is one of the most incredible dividend growth track records in all of business, with 50 consecutive years of dividend increases. I expect them to continue handing out dividend increases for years to come. The company is taking changes and threats seriously. Meanwhile, the stock offers the potential for 8% upside on top of a 4.2% yield while you wait for the company's investments and changes to take hold. If you're looking for a big yield and decades of dividend growth wrapped up in an undervalued package, this stock could be for you. And like I said earlier, this Target's offering a utility-like yield with a much better valuation and potentially much better dividend growth potential moving forward. So there's a lot to like. I think the expectations have been reset. I think the expectations are almost overly conservative. Target's expectations were maybe too aggressive a few years ago, and now they're almost too conservative. And that's what happens in the short term, as I spoke about earlier. The stock market's kind of crazy and a little wick-whack in the short term, and price and value don't really match up all that well. Over the long haul, they tend to reflect each other a little more accurately. But right now, the pendulum has swung quite a bit. I mean, the expectations were maybe a little too high, and now they're just in the basement. And but when you look at valuation, you want to be in the basement. You want bargain basement stocks, dividend growth stocks. And so if the expectations are in the basement and the valuation's in the basement and the yield is sky high as a result, and Target doesn't have to do much to get you where you need to be, I think. So hope you enjoyed the video, guys. As always, it's a pleasure for me to provide this content. It's a pleasure for me to do these videos. I'm humbled to be in a position to provide these compelling long-term ideas to the dividend growth investing community. I hope you enjoyed. Thanks for joining me. Have a great day, guys. Thanks. Bye-bye.